Disclaimer.
AG here. Silver just crashed from $86 to $72, and Wall Street is declaring the bubble officially popped. But here's the part they're ignoring. It won't break below $70, and that changes everything. Something extraordinary happened in the silver market on the final trading day of 2025. And if you missed it, you need to understand what it really means for your money in 2026. Silver spiked to 86.62 per ounce on December 30th, a level we hadn't seen in decades. Then, within just 4 trading sessions, it crashed back down to $72. Wall Street analysts immediately called it a bubble bursting. CNBC ran segments about retail investors getting crushed. The financial press wrote the familiar obituaries about precious metals mania ending in tears. But here's what should grab our attention. Silver did not collapse below 70. It did not retreat to $60 or $50 like it did after previous spikes in 2011 or 1980. Instead, it's holding firm above a price that was literally impossible to sustain for over 40 years. Think about that for a moment. What used to be the ceiling is now apparently the floor. Pop quiz. When a market crashes 17% in 4 days, but refuses to break a specific price level, are you watching weakness, or are you watching something fundamentally recalibrate? The answer determines whether you protect yourself or position yourself for what's coming next. Let me show you exactly what happened behind the scenes during those 4 days, because the official story you heard on the news left out 3 critical details that change everything. First, the mechanics of the crash itself. On December 30th, 2025, as silver touched 86.62s, the Chicago Mercantile Exchange did something they always do when prices move too fast. They raised margin requirements overnight. According to CME Group's public filings, initial margin jumped from $14,000 to $21,000 per contract. That doesn't sound dramatic until you understand what it triggered. Traders who were leveraged suddenly needed to post 50% more collateral immediately, or face forced liquidation of their positions. Within the COMEX system, we saw something unprecedented happen to the physical inventories. Data from the CME shows that in just 4 trading days, holders claimed 47.6 million ounces from registered vaults. That's roughly 60% of what was available for immediate delivery. Think about what that means in practical terms. If you owned paper silver contracts and suddenly needed cash to meet margin calls, you had 2 choices. Sell your contracts at whatever price the market would give you, or take physical delivery and sell the actual metal. The massive claiming activity tells us many traders chose the second option, which meant physical silver was flowing out of the exchange warehouses at a rate we'd never seen before. This mechanical sell-off, forced liquidation from margin increases, created the price drop from 86 to 72. But here's the part that matters. Once that leveraged paper got flushed out, once the traders who borrowed money to speculate got shaken out of their positions, the price stabilized. It found support. And that support level was $70. Now, if this was truly a bubble popping, if silver's fundamentals were weak, if this was just another speculative mania ending badly, the price should have cratered back to where it started the rally. Instead, we're seeing something we haven't witnessed in our lifetimes. Silver, establishing a new baseline price range 250% above its long-term average. But the story gets more interesting when you realize what happened on the other side of the world while our markets were processing this deleveraging event. On January 1st, 2026, just 2 days after silver's peak, China's Ministry of Commerce implemented new export control regulations that fundamentally altered the global silver supply chain. According to the official notice published by China's government, any company wanting to export silver products must now meet specific criteria: annual production capacity exceeding 80 metric tons, and formal government licensing approval. This wasn't a minor administrative change. This was China ring-fencing its domestic silver production. Here's why this matters to you personally. China produces approximately 3,800 metric tons of refined silver annually, according to the China Nonferrous Metals Industry Association. That represents about 15% of total global mine production. But when you account for China's refining capacity, which processes imported concentrates and scrap into finished silver, China controls access to roughly 65% of the refined silver that moves through international markets. These new restrictions effectively mean that Chinese silver stays in China unless the government explicitly approves its export. Companies without the 80-ton threshold or government relationships are now locked out of international markets. The refined silver that used to flow from Chinese smelters to manufacturers in Europe, North America, and Southeast Asia, that pipeline just got severely restricted. Let me put this in perspective with a scenario you can relate to. Imagine you run a solar panel factory in Arizona. You've been buying refined silver from Chinese suppliers because their prices were competitive and delivery was reliable. On January the 2nd, 2026, you get emails from those suppliers saying they can no longer fulfill orders without government export licenses they are still trying to obtain. Your production schedule depends on steady silver supplies, and suddenly your primary source is uncertain. What do? You scramble to find alternative suppliers. You call refiners in Mexico, in Peru, in Canada, and you quickly discover that everyone else is making the same calls you are, all competing for the same limited supply of non-Chinese silver. And this is happening right now across industries. According to the Silver Institute's industrial demand reports, approximately 60% of global silver production goes into industrial applications. Solar panels, electronics, electric vehicles, medical devices. These aren't luxury goods you can postpone buying. These are critical components and products with fixed manufacturing timelines and contract delivery obligations. The solar industry alone consumed over 185 million ounces in 2025, and that number is projected to grow as the new TOPCon cell technology requires 50% more silver per panel than previous generation cells. Electric vehicle production used 88 million ounces for various components from batteries to power electronics. The artificial intelligence boom created surging demand for high-purity silver in advanced semiconductors and data center infrastructure. When China restricts export of a commodity that's irreplaceable in these applications, what happens to the price of available supply outside China? It doesn't drop. It rises. And it establishes a new floor based on the scarcity premium. This brings us back to silver holding $70 despite the brutal deleveraging we saw in early January. The market is telling us something critical. Even after forcing out leveraged speculators, even after margin-induced selling pressure, even after what looked like a classic bubble pop, physical demand from industrial users is strong enough to absorb all that selling and maintain prices at historically elevated levels. Think about your own experience with supply and demand in everyday life. When gasoline supplies get tight, what happens to prices at the pump? They go up and stay up until either new supply arrives or demand decreases. Neither of those conditions exists in the silver market right now. New supply is not coming. Global mine production has been essentially flat since 2016, according to the World Silver Survey. And industrial demand isn't decreasing. It's accelerating with a clean energy transition and technology proliferation. The COMEX margin increase flushed out the speculators who were betting on price momentum. The China export restrictions locked up a massive portion of refined supply. And the price stabilized at a level that would have been unthinkable 3 years ago, but now represents the new equilibrium between available supply and relentless demand. So when you see headlines saying silver crashes from highs, remember what they're not telling you. Yes, it crashed from $86, but it crashed to $70 and stopped. This isn't a market returning to normal. This is a market repricing the baseline itself. The question is not whether silver will crash back to $20 or $25. The physical supply situation makes that mathematically impossible given current industrial demand. The real question is whether $70 becomes the launch pad for the next leg higher, or whether we see a period of consolidation while the market digests these supply changes. And that answer depends on what happens next in the physical market, which is where our story takes an even more interesting turn. If you want to understand what's really happening with silver, you need to stop watching the price ticker on COMEX futures and start watching what's happening inside the actual vaults where physical metal sits. Because there's a disconnect emerging that's so significant, it's creating what traders call a basis trade. The kind of opportunity that exists when the paper market and the physical market are telling completely different stories. Let me show you the numbers that matter. According to CME Group's daily warehouse reports, registered silver inventories, that's the metal actually available for delivery against futures contracts, have declined 70% since their peak in 2020. We're talking about a drop from roughly 185 million ounces down to approximately 55 million ounces as of early January 2026. That's the physical silver sitting in COMEX-approved warehouses that anyone with a futures contract can legally demand for delivery. Now, 55 million ounces might sound like a lot until you realize that global industrial consumption runs around 650 million ounces per year. The entire COMEX registered inventory represents about 31 days of global industrial demand. Think about that in terms of your own pantry. If you only kept 1 month's worth of food in your house and the grocery store supply chain had question marks around it, would you feel comfortable or would you start buying extra? Industrial users are doing exactly what you do. They're securing supply ahead of need. And here's where the market structure reveals something fascinating: backwardation. In normal commodity markets, futures contracts for delivery 6 months or a year from now trade at higher prices than spot prices today. That's because storing physical metal, insuring it, and financing the inventory costs money. But when a market goes into backwardation, when the spot price exceeds futures prices, it signals that people value having the physical metal right now more than they value having a paper promise of metal in the future. Silver has been in backwardation intermittently since late 2025, and the spread has widened significantly in January 2026, according to Bloomberg commodity data. Spot silver in Shanghai was trading above 80 Dai per ounce, while COMEX futures for March delivery were sitting around $71. That's a $9 premium for physical metal you can touch versus a contract promising delivery in 2 months. Ask yourself, when would you pay $9 extra per ounce just to have something immediately instead of waiting 60 days? Only when you genuinely worry that waiting might mean not getting it at all, or getting it at an even higher price. This brings us to the elephant in the room that nobody in the mainstream financial media wants to discuss seriously. Are the COMEX vaults physically capable of delivering against all the outstanding contracts if holders suddenly decided they wanted metal instead of cash settlement? The math gets uncomfortable quickly. Open interest in COMEX silver futures typically runs between 150,000 and 200,000 contracts. Each contract represents 5,000 ounces. That means there are paper claims on roughly 750 million to 1 billion ounces of silver floating around the futures market. The registered inventory available for delivery, 55 million ounces. The ratio of paper claims to available physical metal is somewhere around 15 to 1 or higher. Now, most futures contracts settle in cash rather than physical delivery, and that's normal market function. But what happens if even 10% of contract holders decide they want actual metal? That's 75 million ounces of delivery requests against 55 million ounces of inventory. The system can handle mismatches through rolling contracts forward, finding alternative supply, or raising margins to discourage delivery. But there's a limit to how far you can stretch that before something breaks. We're watching this tension play out in real time through the claiming activity we discussed earlier. When 47.6 million ounces got claimed in 4 days, that wasn't random profit taking. That was sophisticated players removing metal from the system because they calculated that owning physical silver was more valuable than holding paper contracts, even after paying for storage, insurance, and transportation. Let me connect this to something tangible in your financial life. If you have investment accounts or retirement savings, you probably own stocks and bonds through electronic entries. You don't hold physical stock certificates. That works fine because stocks are infinitely divisible and the system is designed for electronic settlement. But imagine if stock certificates were physical commodities with industrial uses, and the total number of certificates available didn't match the number of electronic claims. Eventually, someone demanding their certificate would discover there isn't one to give them. That's the structural risk building in the silver market between paper contracts and physical metal. Now let's talk about why this matters beyond just market mechanics. The shortage we're seeing is not temporary or driven by speculation. It's driven by fundamental supply-demand imbalances that have been building for years. According to Metals Focus, one of the leading precious metals research firms, 2025 posted the deepest annual supply deficit in the modern silver market, 295 million ounces. That means global demand exceeded newly mined supply and recycled scrap by 295 million ounces. Where did that deficit metal come from? It came from inventories, from above-ground stocks, from metal that was sitting in vaults waiting for higher prices. But here's the critical detail. This isn't year 1 of deficits. This is year 5. The Silver Institute's World Silver Survey data shows consecutive annual deficits since 2021. And when you add them up, the cumulative deficit since 2019 now exceeds 1.3 billion ounces. That's billion with a B, roughly equal to 1.5 years of total global mine production. Think about what this means practically. Every year for 5 straight years, the world has consumed more silver than miners produced and recyclers recovered. The gap got filled by drawing down stockpiles that had accumulated over previous decades. But stockpiles aren't infinite, and the high-grade, easily accessible inventory gets used first. What's driving this relentless demand that keeps overwhelming supply? 3 sectors that aren't shrinking, they're accelerating. Solar photovoltaic panels consumed approximately 185 million ounces in 2025, according to industry tracking data. The new TOPCon cell technology that is becoming industry standard uses 50% more silver per panel than previous per-C technology, because it requires silver on both the front and back contacts for better efficiency. Solar installations are projected to grow another 30-40% in 2026 as countries race toward renewable energy targets. There's no substitute material that matches silver as electrical conductivity and cost effectiveness at the scale solar manufacturing requires. Electric vehicle production and charging infrastructure used roughly 88 million ounces in 2025. Each EV contains anywhere from 25 to 50 grams of silver in various components: battery contacts, power electronics, sensors, charging systems. Global EV production is still in early adoption phase. China produced 9.5 million EVs in 2025. Europe produced 3.2 million. The United States produced 1.4 million. Industry projections show these numbers potentially doubling by 2027-2028 as more models reach market and charging infrastructure expands. The artificial intelligence and data center boom created surging demand for high-purity silver in semiconductors, circuit boards, and thermal management systems. Each AI server rack uses significantly more silver than traditional servers because of the power density and heat dissipation requirements. According to semiconductor industry reports, silver demand for electronics grew 12% in 2025 and is tracking for similar growth in 2026 as AI infrastructure build-out continues. Add these three sectors together, and you're looking at over 300 million ounces of annual demand that's not discretionary, not postponable, and has no viable substitute at current technology levels. Industrial users can't decide to wait for lower silver prices. Their production schedules and contracts are fixed. If silver costs $70, they pay $70. If it costs $90, they'll pay $90 because the silver content is a small fraction of the final product as value. Meanwhile, how's the supply side responding? It's not. Global mine production has been essentially flat between 820 and 850 million ounces annually since 2016, according to the World Silver Survey. There hasn't been a major new primary silver mine brought online in years. Why? Because approximately 75% of silver production comes as a byproduct of mining other metals: lead, zinc, copper, gold. When you're mining copper and you get silver as a byproduct, you can't just increase silver production because silver prices went up. You have to increase copper production, which depends on copper demand and copper prices. The few primary silver miners that exist can't scale up fast enough to fill a 295 million ounce annual deficit. Developing a new mine takes 7 to 12 years from discovery to production, and that's if you find a deposit worth developing. Recycling isn't solving the problem either. Silver recycling from jewelry, silverware, and industrial scrap contributed about 180 million ounces in 2025. But that number is also relatively stable because it depends on the scrap generation rate from products reaching end of life. You can't magically create more scrap to recycle. So we've got demand growing in non-negotiable industrial sectors, supply that can't respond quickly, 5 consecutive years of deficits draining inventories, and a paper market structure sitting on top of this physical shortage with 15-to-1 leverage. If you were designing a setup for a supply squeeze, you couldn't engineer it better than this. But here's where it gets really interesting. The smart money, the professional investors who move markets, are starting to position for this, and we can see it clearly in how mining stocks have performed. When silver first started rallying in 2024, mining stocks lagged badly. Silver would go up 15%, and silver miners would go up 5%. Classic disbelief phase, the market wasn't convinced the price move would stick, so why pay up for producers? Investors had been burned before by false breakouts in precious metals, and there was skepticism that this time would be different. Then something changed in the second half of 2025. According to stock market data tracked by multiple financial platforms, major silver producers started dramatically outperforming the metal itself. Kerr Mining, one of the largest primary silver producers, gained 229% in 2025. First Majestic Silver posted returns of 214%. Endeavor Silver climbed 195%. These aren't small speculative mining juniors. These are established producers with operating mines generating cash flow. The sector ETFs tell the same story. The Global X Silver Miners ETF returned 178% in 2025. The Sprott Junior Silver Miners ETF gained 160%, even diversified precious metals. Equity funds with silver exposure posted returns in the 120-150% range. What does this tell us? When mining stocks start dramatically outperforming the underlying commodity, it signals that sophisticated investors are pricing in higher sustained prices ahead. Mining companies have operating leverage. If silver costs $50 to produce and sells for $70, the company makes $20 per ounce. If the price goes to $90 while costs stay at $50, profit per ounce doubles to $40. But the stock price typically goes up more than 2x because earnings growth accelerates exponentially. The rotation from physical metal into producers with leverage means big money is positioning for a longer-term repricing, not a short-term spike. Hedge funds and institutional investors do not chase 200% gains in mining stocks if they think the commodity is about to crash back to previous levels. They make those bets when their analysts calculate that current prices represent a new floor with significant upside ahead. You can see the shift in analyst coverage too. In early 2024, most Wall Street research on silver miners was neutral to cautious. By late 2025, banks that cover the mining sector started upgrading ratings and raising price targets. The narrative changed from interesting speculation on metals volatility to structural supply deficit, creating sustained higher price environment. This is the proof we needed. The physical inventories declining, the backwardation in pricing, the deficit numbers piling up year after year, and now the equity market confirming that professional money believes this situation isn't temporary. Which brings us to the inevitable question. If the shortage is this obvious, if the deficits are this large, if the inventory is this thin, what happens next? There's a policy change coming in February 2026 that most people haven't connected to the silver story yet, but it could fundamentally alter who's buying and how much capital is available to chase limited supply. The Department of Labor has been reviewing regulations around what assets can be held inside 401k retirement accounts. Currently, most employer-sponsored retirement plans restrict participants to mutual funds, ETFs, stocks and bonds. Physical precious metals and certain commodity investments are typically excluded unless you have a self-directed IRA, which most Americans don't use because of the complexity and fees involved. But according to industry sources tracking regulatory developments, there's growing momentum toward allowing precious metals allocation within standard 401k plans, potentially starting as early as February 2026. This wouldn't require every plan to offer metals. It would simply permit plan sponsors to include precious metals, ETFs, or allocated metal accounts as investment options if they choose. Here's why this matters on a scale most people haven't grasped. Americans currently hold approximately $9 trillion in 401k accounts, according to Investment Company Institute data. Even if the regulatory change happens, and only a small fraction of plan sponsors add precious metals options, and even if participants only allocate 2 to 3% of their portfolios to metals, you're potentially talking about 180 to 270 billion of new capital that could flow into precious metals markets. Think about your own retirement account for a moment. If your 401k suddenly offered a silver allocation option next to your stock and bond funds, and you decided to put even 5% of your balance into silver, you'd be joining potentially millions of other Americans making similar decisions. The silver market isn't like the stock market. There aren't trillions of dollars of metal available to absorb that kind of demand. Total global silver inventories that could theoretically be purchased by investors might represent 100 to 150 billion of value at current prices. You can see the math problem. Major banks are already positioning their clients for this potential shift. Bank of America. Its commodities research team published a report in late 2025 projecting gold could reach $5,000 per ounce in a scenario where metals gain even modest mainstream allocation from retirement accounts. While they were focused on gold, the same dynamics apply to silver with even more force. Because the silver market is roughly 1/10 the size of the gold market, meaning the same dollar inflows create much larger price impacts. UBS released research in December 2025, laying out base case and upside scenarios for silver specifically. Their base case, the conservative projection, assuming current trends continue without major disruptions, targets silver in the 55-65 range for late 2026. But their liquidity squeeze scenario, which models what happens if industrial demand continues growing while investment demand accelerates, projects silver potentially reaching $100 or higher as buyers compete for genuinely scarce supply. Now, you might be thinking these sound like wild projections designed to generate attention, but let's do the math ourselves based on what we already know is happening, not speculation about what might happen. The industrial sectors we discussed, solar, EVs, AI infrastructure, are consuming over 300 million ounces annually and growing. That demand is locked in by manufacturing contracts and technology requirements. Companies can't suddenly decide to use less silver. They're using the minimum amount their products require to function. Global mine production sits around 830 million ounces. Recycling adds about 180 million ounces. That's roughly 1,110 million ounces of total supply. Industrial demand takes 750 million ounces. Jewelry and silverware consume another 200 million ounces. That leaves approximately 160 to 110 million ounces for investment demand. Coins, bars, ETFs. But here's the constraint nobody talks about. Accessible reserves. The silver that's actually available to buy right now, the metal sitting in places where you can take delivery within 30 to 45 days, is far smaller than total above ground stocks. According to metals logistics experts, most silver inventory is already spoken for. It's in industrial stockpiles waiting to be used. It's in allocated storage for existing investors. It's in jewelry stores as finished goods. It's in vaults as collateral against financial contracts. The truly liquid silver, metal that could be purchased and delivered to a new buyer quickly, represents maybe 30-45 days of global industrial consumption at any given time. When you're running industrial supply chains for solar manufacturers or electronics producers, 30-45 days of buffer is already tight. You don't want to go below that because supply disruptions, shipping delays, or refinery maintenance could leave you unable to fulfill production orders. This is why we're seeing Shanghai trade at premiums to London and New York. This is why COMEX registered inventories keep declining even at $70 silver. This is why backwardation persists. The physical metal that industrial users need isn't really available at any price they consider reasonable, so they're securing it in advance and paying premiums to guarantee supply. Now layer in the TOPCon solar cell issue. The solar industry is transitioning from PERC cell technology to TOPCon because efficiency improvements are worth the extra cost. But TOPCon cells require approximately 50% more silver per panel, jumping from about 130 milligrams per watt to 200 milligrams per watt, according to solar industry technical specifications. Solar installation projections from the International Energy Agency show capacity additions potentially reaching 450-500 gigawatts globally in 2026. Running the math on silver intensity at TOPCon specifications, that translates to roughly 200 to 220 million ounces of silver demand just from solar in 2026, up from 185 million in 2025. That's an incremental 20-35 million ounce increase from one sector alone. Where does that incremental demand get filled from? Not from new mine production, which is flat. Not from recycling, which is stable. It comes from inventories, from drawdowns of existing stocks, from higher prices pulling supply out of other uses. And here's the constraint that makes this truly asymmetric. Mining can't respond. Remember, 75% of silver is byproduct of other metals. The primary silver miners that do exist are already running their operations. You can't flip a switch and increase production 20% or 30% to meet demand surges. Even if silver hit $150 per ounce tomorrow, a copper miner in Chile isn't going to dramatically increase copper production just to get more byproduct silver. They produce copper based on copper demand and copper prices. The silver is nice additional revenue, but it's not driving the production decision. The few primary silver mines that exist can potentially optimize their operations at higher prices. But we're talking about marginal improvements, not game-changing supply increases. Developing entirely new mines takes 7 to 12 years minimum and requires hundreds of millions in capital. In an environment where silver prices have been volatile and unpredictable for decades, mining companies haven't made those massive capital commitments. So you've got demand that mathematically must increase based on technology transitions already in motion, supply that structurally can't increase quickly, inventories that are already declining from years of deficits, and potentially hundreds of billions in new investment capital that could start competing for metal if retirement account rules change. The math says one of three things has to happen. Prices rise significantly to ration demand. Industrial users face supply disruptions that force production delays, or the paper market structure breaks when delivery requests exceed available inventory. Let me be specific about what to watch for in the coming months, because these will be the signals that tell you which scenario is playing out. First, watch for COMEX delivery issues. If you start seeing reports of delivery delays, force majeure declarations, or cash settlement being pushed on contract holders who requested physical delivery, that's the canary in the coal mine. The exchange's credibility depends on its ability to deliver physical metal against contracts. If that system shows cracks, the price discovery mechanism itself gets questioned, and capital will flee paper contracts for physical metal or mining equities even faster. Second, watch mining stock performance relative to silver prices when Q1 2026 earnings get reported. Producers are going to post massive earnings beats because they're selling metal at $70, $75 when analysts were modeling $50, $55 prices from earlier in 2025. If the stocks accelerate even higher after earnings, despite already being up 150 to 230% in the past year, it confirms that institutions are still accumulating positions because they believe current earnings represent a new baseline, not a peak. Third, and this is the big one, watch for the retail FOMO phase. Right now, most mainstream investors don't own silver. They might own some gold in a portfolio, but silver is still viewed as a speculation or a fringe investment by typical financial advisors. When your neighbor starts asking you about silver when CNBC runs segments explaining the industrial shortage to general audiences, when retail investors who've never touched commodities start buying silver ETFs and coins, that's when you know the awareness has shifted from early adopters to the broader market. Here's what's critical to understand about that FOMO phase. It does not mark the top, like many people assume. In commodity supply squeezes, the late crowd does not arrive at the peak. They arrive when the fundamentals finally become undeniable enough that even conservative investors feel compelled to participate. That buying pressure, stacked on top of already tight physical markets, is what typically drives the truly parabolic phase. Think back to oil in 2007, 2008. The fundamental supply-demand story was building for years, declining spare capacity, rising demand from China and emerging markets, underinvestment in new production. Sophisticated energy investors were positioned early, but the real price explosion from $90 to $140 happened when pension funds, endowments, and retail investors finally recognized the shortage was real and rushed in. The late crowd didn't kill the rally. They supercharged it until demand destruction finally kicked in at extreme prices. Silver is different because there's no demand destruction coming. Solar manufacturers can't decide to skip installing panels because silver hit 100. Electronics producers can't eliminate silver from circuit boards because the price doubled. The demand is technically determined, not discretionary. What does this mean for you personally? It means that if the math we've walked through plays out, China keeping domestic supply restricted, industrial demand continuing to grow, mining unable to respond, retirement accounts potentially adding allocation, COMEX inventories continuing to decline, then silver at $70 isn't the bubble top Wall Street thinks it is. It's the early innings of a repricing that reflects genuine scarcity in a commodity the modern economy can't function without. I'm not telling you to rush out and buy silver tomorrow. I'm telling you to understand what's happening beneath the surface so you can make informed decisions as events unfold. Watch those 3 signals: COMEX delivery issues, mining stock behavior at earnings, and retail awareness shifting. If you see those dominoes starting to fall in Q1 and Q2 of 2026, you'll know the market is confirming what the math already told us. And at that point, the question won't be whether silver can hold $70. The question will be whether anything below $100 was ever realistic, given the supply-demand fundamentals we're living through. The crash from $86 to $72 shook out the speculators who were playing momentum. What is left is the fundamental bid from industrial users who need the metal and investors who have done the math on scarcity. That's not a bubble. That's a repricing. And repricings don't typically end at the first resistance level. They find a new equilibrium that reflects the new reality. The reality is that silver became structurally scarce somewhere between 2021 and 2025, but the market is still pricing it like it's abundant. Eventually, price catches up to reality. The only question is whether you recognize what's happening while it's still early, or whether you wait until everyone else figures it out and you're competing with the late crowd for what's left. That's your choice. But now, at least you have the information to make it. Thanks for sticking with me through the numbers. I know silver math isn't everyone's idea of entertainment, but knowledge is the only edge we've got. Hit that subscribe button if you want more financial reality checks before the crowd figures it out. And drop a like if this changed how you're thinking about what crashed really means. Stay sharp out there.